Well, hello, everybody. This is Randy Wootton, CEO of Maxio, and your host of SaaS Expert Voices, where we bring the experts to you to talk about what's going on in SaaS today and what are some of the trends that are unfolding tomorrow as you build your company or oversee your company or invest in SaaS. Super delighted to have Roee Hartuv, who's actually coming to us from Germany today. He has an incredible background and experience. He's been working as a startup executive for the last 18 years in high growth SaaS companies. So lots of expertise to bring to bear. He's built and managed sales, CS, and marketing teams. And in our pre-brief, we shared a lot because that's kind of my background as well. But what he has that I don't have is he's currently a revenue architect at Winning by Design, which is one of those great sales methodology companies. Really, the coolest kids have it. We signed up for it, but along the lines of Challenger, along the lines of target account selling, and all the other models, Sandler that you could. It's an incredible program, and I can't wait to hear Roe's lessons learned and some of the best practices that he's going to share with us. Welcome, Roee.
Great to be here. Thank you for having me.
So we have all of this exciting things to talk about, but in our pre-brief, we had this really interesting conversation around, are we in a SaaS recession, right? Like, what is that broader context that we're operating in? Like, I'm arguing for my board right now that it's been super hard and there's been a contraction in investment, and investment means that CFOs aren't spending money. And it's just, just talk to my sales team. They're like, it's harder and harder than it was 2 years ago. And you had a really interesting perspective on terms of the IPO market and what's been happening. Could you just share a little bit about your broader perspective, what's happening in the market and how this plays out for private companies and thinking about PE versus VC?
Yeah. So everybody feels the stress and the recession, right? Growth has declined drastically for most of the companies out there. We're all feeling that. We had layoff rounds. We've all been there. But I want to add another perspective, right? And another indication that we are actually in a recession. And the fact that there are no IPOs.
It's mind-boggling. Do you want to recite the facts? I got them written down here, but it is mind-boggling what's been happening.
Yeah, like what are the recent IPO SaaS companies that went IPO? We had OneStream, 6 weeks ago. Before that, Reddit. That's it. Like I'm probably missing a few that went under the radar, but that's basically it.
Yeah, I mean, to put it in perspective, and you had shared this in our pre-brief, in 2021, there was 98 software IPOs. In
Yeah.
2022, there was one. In 2023, three. And to your point, this year so far, there's only been three-ish.
Yeah.
And just mind-boggling. And then I think the other thing you were talking about, what I thought was really interesting, was the number of private unicorns.
Yes. That's another. But before we get to that,
Yeah,
like,
sure, please.
why am I looking at IPOs? Because IPOs we're experiencing a bottleneck because our entire industry was like, company was founded, they grew, got investments from VCs. At some point, there, there was an exit event. Usually, it's IPO or acquisition, and basically, those companies became public companies, and the money went back to the VCs who went back and investing, and that's that we had that cycle. No IPOs means that we're stuck. Like there's no movement here. Which brings me to the next point. Like back in 2021, um, according to Deal Room, there was 1,200 private SaaS companies, unicorns, unicorn private SaaS companies. Just as a perspective, at public SaaS unicorns, there were 364. And that includes Salesforce, Meta, um, all these fantastic companies that were already public, right? Software companies, SaaS companies, 364, while in the private market, there were 1,200.
And your point, just for people who may not know, a unicorn is $1 billion valuation.
Yeah.
And the distinction you're making is that public companies who have all their financials out in the open, everybody's reviewing them, only 364 of them were actually valued at greater than $1 billion. Whereas private companies, where their financials aren't public, but you have a bunch of exuberance with investors who think these are going to be the next $1 billion companies on the market or more, there was almost 4 times as many $1 billion plus valued companies, and they haven't gone public.
Exactly.
So what's happening?
And all these companies were preparing to go public. They're still preparing.
Yeah, yeah. I
Well, some of
remember, and
them
to
cease to
your point,
exist, right? But most of
well,
them
some
are
of them
still
have
waiting.
ceased to exist, and some of them have had to take down rounds. And I think the other issue is a lot of people don't want to take the down rounds, right? Because then all the VCs have to write down their valuation. I remember when I was coming up through, when I was at Rocket Fuel, we were a public company. We were 400 something million gross, 240 million net. At that time, this is 2015, 2017. The rule of thumb was if you could get to $100 million, you were tracking for an IPO. And
Yeah.
today, I think what we're seeing is it's at least 300 million. I mean, one stream that just came out, and they're the bell of the ball. They had all the great metrics, incredible net retention, incredible gross retention, but they were $500 million. And so
Yeah,
you
that's
think
got to
about,
be the new norm, right?
sorry,
We're working with a few pre-IPO companies,
yeah,
right? And we're like 100 million, no way, even 300. I'm currently supporting a 300 million ARR company. They have planned to do an IPO back in 2022. Of course, that got postponed. They still plan next year, but of course that will continue to be postponed. Like they still haven't reached that 500 million. Now, I don't know what's going on with the discussion with the investment bankers, and that they are telling them, "Hey, this is the right timing for you," and like at the end of the day, there are like, let's say, a few private investors, and they're working with all those, let's say, 1,000, 1,200 unicorns, and yeah, eventually the market can absorb only, and that's in the good days, 50 IPOs per year. What's going to happen with the rest? Who knows?
well,
Or
I think that's what we were talking about is some will go to PE, right? So you're seeing an enormous amount of acquisition, and the PE firms have a lot of capital on the side, right? The capital commit, not actually in the bank, but people have said, yeah, we want you to go buy. And some will be bought by strategics, but I think the mix has really changed. But what does this mean? Like we were talking about a recession. So why does that create a knock-on effect in terms of the recession? Is it to your point that the VCs aren't getting the liquidity from the transactions to be able to go back and invest in early stage companies? Is that the primary reason, or is there something else?
that's exactly the reason. And that what that creates is there are no additional funding round,
Right.
but there are fantastic companies with great products that have 100, 300 in ARR. They already proven that they are a successful company, but still most of them are not profitable and they're losing money and they need additional funding in order to continue to maintain operations.
In our
And that's
Maxio
the problem.
in our Maxio growth report, one of the things we allude to is that dynamic of the VC funding that has continued to go down. Um, Up until this quarter, it's increased in total dollars. The In terms of quarter over quarter investment, the number of deals is still low and decreasing, and that to me shows that what you're finding is VCs are still doing deals, but they're only doing really good deals. And so you have
Or deals that have AI in the title.
right, everybody in AI. That's true.
That's right.
So Roey, so here we are. So we're in a recession. Everyone's freaked out. I know friends when they were trying to raise money. It used to be raise money for every 18 months, right? You raise for 6 months, you execute for 12 months, you raise, and you're trying to hit that what used to be vogue, the triple triple double double double, the T2D3 growth
Mhm.
rate. Um, Let me ask you before I want to get into, so what should you do? One of the things you have is this really interesting viewpoint because you're working with a bunch of companies. What are you seeing in terms of growth rate? Obviously without sharing private information, like did it used to be 3 years ago, 4 years ago, the assumption was 20% growth and those were the companies you're working with? Today it's 15% growth. Like what are you seeing in terms of the reality of growth rates broadly across your portfolio? Obviously you guys help people get better, but when you start with them, what's happening?
So back then in the good old days, as we call them, 2020, we worked with companies that triple, triple, double, 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 right? So they double their growth. They double the ARR year over year.
Right.
That was the type of companies that we work with. Nowadays, 30% projected to next year. Some still have like very high targets from the investors,
Yeah.
and that's an indication, right? So we the market was in a shock for like 2 years. We let people go. We extended runways, but now the investors are coming back and say, "Hey, 2025, you guys need to find a way to continue to grow."
And drive efficiency through AI, right? Like,
Drive efficiency, yeah, but let's stop with the AI. But drive efficiency would
yeah,
mean
right.
we're not only going to measure you guys on the growth rate, we're also going to measure the costs.
Yep.
And that's the big difference.
Yeah, especially for VCs, right? It used to be what we called the growth at all costs. Put a bunch of money in there. It's a land grab, grab market share, invest like crazy, and go to market. Everyone's buying. Every startup is buying each other's startup
Yep,
technology, and that shift to that efficient growth model. And everyone's been talking about it, like the rule of 40, where you got to be able to show that you're on a path to profitability. If you're still
yep,
growing fast, you can be a little negative EBITDA, but if your growth is slowed down to 20% or less, you actually need to be profitable to show that you're not going to burn because the profile won't get invested in. So I think
yeah.
that's where we're seeing this real dynamic. Um, and so in the Maxio growth report, which we'll include in the show notes, what we've seen across our 1,500 customers that are in the report, we have 2,000 total, is that the average growth rate was about 17% year over year. And this is all private companies. So these are all the companies that you're talking about. We work with pre-seed to a couple hundred companies greater than 100 million. Um, so I guess one of the questions I wanted to follow up on. So you work with companies where there's still this artificial, unrealistic expectation because it's always easy to build a plan. Right here, let me show you the assumptions. Now we're in the back half. We're just wrapped up Q3 for most companies that are calendar year, fiscal year. How many people are actually hitting the targets that they set out in January? The companies that you're working with, is it most are still okay, or many are like, oh God, we aren't hitting our growth numbers, so now we've got to go into Plan B.
Many are in that, oh God.
Yeah,
Right.
yeah,
And I think everybody's updating their forecast for the entire year, right? We just still have 1 quarter to go, but
yeah.
everybody is updating that.
They're all replanning, right? They're all trying to do the stub budget for the final quarter, and so they can hit their bonus targets or negotiate.
No, even they're looking at 2025 because everybody's now
Ah,
planning on
yeah,
2025.
right.
So
Yeah, right.
the one company, for example, last year they had like that board discussion on 2025, and it was all about, hey, look, we're not going to hit our targets in 2025 and 2024, and you guys want us 80% year over year growth. You guys invested us 2.5 years ago. The market was different. What we predicted that we're going to do in 2024 and 2025 is no longer applicable. And that's the conversation. It's not an easy conversation, but
No,
yeah,
I've been on
they
both
have to.
sides of it, and it's really hard. So, what are you finding? As we were talking about in a pre-brief, in a recession, what are the classic plays? What are the two things that people, initially focus on?
Yeah, extending that runway, right? Coming back. There are no fundings. You need to extend the runway. So this is the first thing that everybody did. Cut costs, which basically mean letting go of people.
Right. Well,
And let's look at our bottom 20 or bottom 40% and cut them off.
yeah, I think
And
that
I
was the
want to tell
thing.
you a secret from our experience. It did not influence the top line as predicted, meaning it was a healthy cut.
Hmm.
It was a healthy
Oh, I
reduction.
see what you're saying. Getting rid of the people. Well, I think what happened was we were in that weird scenario where you couldn't hire anybody and you're growing like crazy. So people were staffing. Like your number one constraint was capacity. And you have this many more customers, you need this many more implementation folks. But to your point, when they did the cut, and I think you saw that broadly across the space, the big guys got in late, but millions of jobs lost. It was kind of like pulling the gum out of the machine. It was like, no, no, no. It was that, to your point, it was a healthy cut. They were able to maintain top line, maybe not at the same rate, but they were able to continue to grow. So great, everyone cut heads. Now we're back into a situation where it's kind of a buyer market versus an employer market,
Mhm,
but
mhm.
we're still struggling to get to profitability. So what's the next thing that everyone's going to be focusing on?
The struggle, first of all, everybody's struggling to find how do we move the mindset from that grow at all cost, hire people just to fill in the ranks, and let's focus on things like productivity per rep, how much revenue each seller brings in. How do we do that? Again, in the good old days, when we wanted to double our revenue, we just double the amount of sellers that we had. But we no longer have the ability to do that because we cannot pay the salary. So we need to double our revenue. We can, but let's say, for the sake of the example, we want to double our revenue. We need to find an effective way to do that. That transition is a totally different company and how a company operates and the culture of the company. That's where we spend a lot of our time with our customers.
Well, let's do that. Let's shift into the lessons to learn from your customers. I think the segue here was your broader point, which is once they cut the heads, then they start focusing on efficiency, and that efficiency is through automation. It's through different ways of doing metrics and automate, operate, eliminate. Like, are there processes you can totally eliminate? Are there things you can outsource to partners, et cetera? But you have a list of great lessons learned from your customers that you're working with right now. First, let's start with yeah. So just what doesn't work in terms of your customers? Like, what are the things you're seeing? What people saying? Oh, we're going to go, you know, do this. You're like, oh, I don't think that's a good idea. I've seen 15 people do that, and then we'll go into what works.
All right. The classical thing is focusing on acquisition only. Growth from acquisition at some point has like a ceiling, right? There's there's some sort of ceiling that above that a company cannot continue to grow through acquisition.
And
And
new
at
logo
some point,
acquisition is what you're talking about, not
yeah,
acquiring new companies. You're talking about
yeah,
that
yeah,
motion.
acquisition of new customers.
Yeah,
Yeah.
reverses going into your customer base, which we'll talk about in expansion. So new logo acquisition, you're suggesting there's some sort of asymptote that you start to get to the efficient frontier of you just can't add another body. You either need to open up a new segment or a new region or something. Is that what you're pointing to?
Eh, yeah, let's say that. But you're selling to a segment. There's a certain amount. There's a limit to how much you can sell in a given year, right? There's yeah. It just at some point it plateaus. So I don't know. You're generating 20, 50 million in new ARR. At some point, that's the level, right? At, there's a stage that a company now needs to focus on. You said expansion, but it's not only expansion; it's also retention.
Yep.
So let's talk about retention first. When you think about recurring revenue business, most of the revenue comes from existing customers that keep on renewing with us. And this is an exercise everybody should be doing and know the numbers. 80% on average of a company, let's say mid-market, mid-stage kind of scale-up company, 80% of the revenue comes from retention usually.
Well, that's the beauty of the SaaS model. I remember being at Salesforce and joining them in 2000 and gosh, it was maybe in 2012. So it wasn't huge. And I remember Benioff standing up and basically talking about just that. And I joined the customer success team under a woman named Maria Martinez, the emphasis around the retention. They knew what their full fiscal year was going to be, plus or minus a couple of percentages at the beginning of the year, because they had the retention so dialed in. They knew that was true. So the new logo acquisition, to your point, was important, but it didn't affect their earnings. And I think that's why you've seen the SaaS business model and SaaS companies, it's all about future profits and the predictability and being able to deliver on that. Even if a lot of the companies used to be unprofitable, they've been able to show they can go profitable and then drive growth. And so, to your point, like understanding gross retention again across your client base, what are some good metrics in terms of gross retention? Is it at least above 90%? Is it you're in trouble at your 70%? Like, what's the point at where you're like, this company really is struggling on gross retention?
So it depends, right? It depends on your ACV. It depends on the segment that you're selling to, right? So let's say you're an enterprise, you're selling to enterprise Fortune 1000 companies. Your retention, and usually it's very big contract, large ACVs, multiple year contract, your retention rate should be close to 100.
Right. Because and it's very hard to get out, right? So you go through this long sales cycle, 12 to 18 months, getting up and going. You've gone through a buying process, procurement, implementation process, the rollout. Like once you're in, you're like, woohoo! But it takes forever to get those guys. So yeah,
Yeah.
closer to 100%. So go to the other end of the spectrum. Now we're talking about low ACV, $5,000 deals. You can get up and running in a week, not PLG, but sort of that kind of
Yeah.
first stage where you need a sales motion. What do you find is the gross retention at that end of the spectrum?
Above 90, it should be, right?
Yeah.
At some point when you go too low, you're not really a recurring revenue company, you're reoccurring. Yeah, to a certain extent, right?
Yeah, the monthly when they're just purely monthly, you don't know if they're going to continue. I think there's a lot of PLG companies start that way. They go out with a usage based model, monthly pricing, and they're trying to convince people, no, no, it's ARR. But really, is it really ARR? But yeah, I think for us, anything below 90%, if we're looking at deals, you scratch and want to go after it and see what's really happening there.
Yeah. And coming back to where we started off, companies need to start looking at it, at increasing that. Every percentage point from retention comes at a fraction of the cost of acquiring new customers. And we're looking at efficiency, we're looking at cost. Let's focus on that. So everybody knows that the recurring revenue business model is based on recurring or existing or customers renewing with us. But what they actually follow and implement and where they spend their resources on, usually it's back to acquisition.
Yeah. So let's go there a little bit. Let's talk a little bit. One of the things you mentioned earlier was what doesn't work is when companies conflate product market fit with go to market fit. And again, I think this is one of the things you and your company do really well is drive this distinction to the ground with your company. And so tell us a little bit about when does someone have product market fit and what's the distinction or the evolution of go to market fit?
Yeah, so let's start off with product market fit. That usually happens first, right? Yeah, this is where customers are willing to pay for your products. Now, you can ask three different people what product market fit. You'll find you'll get like five different answers. And I like to say, you ask a VC, like a Series A investor, what product market fit. The usual answer that you'll get $1 million in revenue or recurring revenue, and let's say 20 customers, right?
Right.
You ask a founder, how do you know when you reached, how did you know when you reached product market fit? And they would say, hey, it's like riding, surfing and riding waves, right? At the beginning, it's very shaky, but once you catch that wave, you know that you caught the wave, right? It's smooth sailing from there on. Um, we like to say it's not easy always, but when customers come back to buy the same thing.
When they
So
renew, when you have a
when they
series of renewal.
renew.
Yep. Yep.
Yeah, and sometimes when you have long contracts, you don't really know that, but you have leading indicators that allow you to understand. Okay, the usage is high. I know that they're going to renew, so that's product market fit. That happens roughly again, and I will take what the Series A investors say around 1 million, give or take. Could be earlier, could be later. But then you have go to market fee. And that's where you start to have a repeatable process going to market. And a repeatable process, and usually it's around the sales process, is that you start to see common numbers across that sales process, meaning the sales velocity, the time to close. It's not all over the place. It's not I'm closing one client after two calls, 10 days, and another clients after 6 months. One ACV is 20K and the other one is 120K. We all know that in the earlier stage, you're all over the place, right? Your numbers are all over the place. But at some point, they start to, to, to appear around a certain average. So all of the sales process start to look the same. You're selling to the same segment. It takes the same time, the same amount of meetings. Um, the sales process look the same, and that's where you know you have found your go to market fit. And
And
when you have achieved that, this is the time to press on the gas and move into that scale up mode.
awesome. We'll talk about that in just a second, but I think you're absolutely spot on in that this idea of like it's when you understand your ICP, you've been able to articulate that, you understand the persona that you're going after, and you understand the competitive context with which you're operating. So there's a certain value that this prospect is going to ascribe to your solution. They're going to compare it to alternatives like from spreadsheets to buying a Porsche or whatever, and you're going to figure out what the price point is. And so to your point is once you start to get enough at bats where they start to look the same, that's when you can also start to your point, add on the gas, i.e., adding more reps. And so this is where it's so important when you're moving from that product market fit to go to market fit. When sales is moving from founder led sales to having a CRO or a VP of sales who can come in and help scope all that and has enough understanding of a process like winning by design or something along those lines.
Mhm.
They know how to run a pipeline, know how to run a funnel, know how to run a process, so that then they can start doing the qualification of prospects, and you start to get conversion analysis, win rate analysis. So you start to build this radar around go to market. If you don't have that, then you start throwing reps at the problem, investing more dollars in reps and then marketing to feed the reps. You're back in that mindset of growth at all costs. You've just spent money and you're throwing it at the wall and you're just hoping to bring stuff in. And so I think that transition between product market fit and go to market fit is so essential.
Yeah, I want to give an example of last year I was working or supporting a company. They were at like 10 million ARR, around that number. I don't remember the exact number. At that number, it's quite impressive, right?
Yeah.
You go to your Series B, Series C, raise raise the next round, scale.
Yeah.
But when we looked under the hood, when we started to actually work with them, we understood that they have three, we call them go to market motions. So they were selling to enterprise accounts, and that was around 3 million. They were selling to SMBs, high velocity kind of sales process. By the way, same team. And that
Wow.
was around 5.5 million. And additional 3 million came from like a self-serve PLG kind of motion. They were all over the place. And when we looked at that, none of these three motions were actually mature. Each motion by itself did not have a go to market fit. It wasn't a repeatable process there. It was the same seller, sometimes selling into this segment, using, I don't know, reference, or the investors came in, some strategic kind of companies, and then they sold to SMBs doing outbound processes with numbers all over the place. And PLG, yeah, worked somehow to the totally different persona type, individuals. Yeah, that's an indication that the company's coming back to what you said, like all over the place. Nothing, they weren't ready to scale. And when they came to us, it's like, okay, tell us where to. We want to do everything at once, and like, no, 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 stop. Let's just focus. We focused on the SMB market, and we actually created a process and told them to focus only on that.
I think that is one of the greatest pieces of advice for early stage companies is understand your ICP, run one go to market motion for one product.
Yeah,
Nail it. And there's always this inflection point. People talk VCs are like, "Hey, when are you going to go multi-product?" Right, but you got to get the first product right, and that is that the value is clear, the pricing and packaging, the monetization is appropriate, and then you got enough customers that are continuing on that you start to feed that SaaS flywheel that we were talking about before.
exactly.
So you're sort of poking at this or approaching this conversation we had before about the difference between the startup versus scale up mentality. Can you,
Mhm.
the people that you like, that was a startup mentality, representative startup mentality. Broadly, what they're coming in talking to you, like, what are those people thinking about? How are they, how are they framing their challenges when they're in startup mode? And then we'll shift to what are the changes they need to make to be in scale up mode.
Yeah, in startup mode, it's like testing. There are a few companies out there that they have nailed this. That they had like a uh, very defined use case problem and product that solves that use case, that they know right from the start. This is what we're solving, and yeah, they're ready to scale. A company like that is HubSpot. I always like to look at HubSpot. HubSpot started off with a marketing automation platform,
Yeah,
and they were focused on that until they hit 100 million in
right.
ARR before they launched their CRM platform, which was the
Perfect
second part.
example. Perfect example. Yeah.
They were spot on. They were nailed on that use case, and they did that. But unfortunately, that's not how most companies find that growth path. Usually, companies try out different things. They sell to enterprise. They sell PLG is a bit extreme when you're doing both of them at the same time. But let's say enterprise and SMB, and doing different motions and trying out until something sticks.
So that big distinction you're making is what we were talking a little earlier before between product market fit and go to market. If you're scale up mentality, you're focusing on that go to market fit. And that leads you to do some other things. So, like, for example, what are the type of people that you find are being hired at startups? What's the mentality for how you hire and what they do versus those that you start to bring in when you hit scale up?
Yeah, startups are, we know that, superstars, jack of all trades, right? These are the people that whatever you throw at them, they will be able to figure it out. That today we're selling to this vertical, industry vertical, tomorrow we're selling to another industry vertical, and guess what? We're adding a sales engineer to help you do the sales. They will figure it out.
And they love that. They actually like the
They
chaos.
love
And
the chaos, right?
if it changed to if it stayed too consistent, they would get bored and want to leave and go to the next startup. But they like the chaos. In that model, process is anathema. And I think the
Exactly.
point you made in our pre-meeting was that it's success is based on people versus process. Can you say a little bit more about that? I mean, when you come in and see these guys and like the company, not the one you just referred to, but maybe another one, like how it showed up, you got a bunch of rock stars and they're like, no, 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 you slow me down if you introduce any process. I know what needs to be done here. I'm like a, frothing revenue dog. I'm going to find the next deal. Like what, how's that epitomized in some of the customers you work with?
Yeah, one of the things that we do is help create a process. Usually, just let's for this example, sales process, right? And hey, guys, we're welcome. You're now a scale up company, and in scale up, you need to have processes in place.
But they don't want that. So how does that happen? Do you have the CEO call you in? Is it the board that brings you in? I mean, they're not going to volunteer and say, "Yeah, what I want is more process in my life."
Yeah, so usually it's the CRO. The last company I work with, or I'm still working with, VP of Sales understood that. He has done this with another company, and he told me, I know that what we're doing together will cause some of my reps to leave, and that's perfectly healthy. The culture of the company is going to change from everybody doing their own thing, opening partnerships and figuring it out how to bring in the revenue. Now we need to start standardizing, creating a unified process across the different team members.
And ultimately to drive efficiency through consistency, that you have people, you can bring on people, you can train them, you can onboard them, you get them up to skill. So rapid time to onboard, right? Reduce time to first sale. And then the way I think about it is if you get the processes in place, you can help convince your AEs that they're going to be able to pay their mortgage. They're going
Yeah,
to hit their quotas. And so the process goes all the way through go to market. And then you guys have this great bow tie architecture where you talk about, post sales. But I do think there's this at some point you're going to move away from being the 22-year-old, woohoo, I love closing anything, to, oh my God, I got a family. I need to be able to trust the process. And I think sales, in many ways, I worked with a guy who was an incredible sales leader. He would talk about it is the process, it's the activities that you do. Are you getting coached on a regular basis? Are you doing the film reviews? Are you being held accountable for your Monday morning forecasts and your Friday afternoon checkout? And that mentality of the professional salesperson who's able, they need, in many ways, that container to feel like they're being set up for success.
yeah. Which reminds me of a conversation I just had today. with a company that we're working with, one of the things that we always focus on are the frontline managers. So we focus on that change management, introduce new processes. Our ambassadors of change are the frontline managers because without them, nothing will stick. So we need to get their buy-in. One of the things, like the session that I had today, was to introduce we call it an operational rhythm or a cadence. There's We know how it is, right? You have the top performing reps and they are promoted to become frontline managers. And if they were not managed or coached properly, then they'll just manage the way they were managed. In a lot of cases, or in this specific company that I'm talking about, some managers did one-on-one on a weekly basis, some did it on a monthly basis. They don't have forecasting meeting, they don't have deal review meetings. The one-on-one meetings turn into a deal review meeting, and pipeline meetings, yeah, nobody's really responsible for pipeline. QBRs are not even doing that. And we know, you're coming from Salesforce, that's Monday morning, you have a team
Oh
meeting,
yeah.
everything. That's the cadence. And I presented that to them, and some of the frontline managers were, you know, making comments. I don't know if they'll adopt my recommendation, which, by the way, is completely aligned with the leaders, right, with the
Yeah.
executive team.
Yeah.
That's what they asked. And all of a sudden comes somebody that tells them, "Hey, Monday morning team meeting. You have to meet 30 minutes at least once a week with every rep. You need to listen to calls. Here's the QBR template. You need to start implementing that. We missed this one, but Q1, you guys need to introduce that to your team members." That change is difficult.
Yeah, and I think the key insight there, and there's a great author, Linda Hill, professor at Harvard, who wrote a book on this, and I'm totally forgetting what the name of it is. But her essential point was that people who get promoted to manager are probably people who shouldn't be, because they've been incredibly successful as individuals and they
Yeah,
know what needs to be done. And
yeah,
then all of a sudden you become a manager, especially as a sales manager, and all of this stuff feels peripheral. It's not essential. What they don't realize is that most of their team are going to be people that are either early stage professionals or got kind of B-level AEs, and their value as a manager is to unlock the potential of the people and the team. And that is a different way of thinking about what their role is. And I think I've had sales managers who've gone back to become AEs because they make more money as an AE and they don't want
yeah,
to deal with all the people issues. But
yeah.
everyone thinks the trajectory is you got to be a manager and then a director and then a VP. And it's like, well, yes, if you like doing these sort of things, and then having a company like yours helping you learn what is the playbook for how to become a successful sales manager and then sales leader and CRO is one of those career transitions that is critical. And you can still make a lot of money and not do it. But if you want to scale, if you really want to move forward in your career to your company's name, winning by design, you have to have a design.
Exactly. Now I want to connect what you just said to what we talked about earlier and connect that to the SaaS recession. Most of the frontline managers today have never experienced what we're that they're in there, and they haven't experienced that. A lot of the frontline managers were doing fantastic as individual contributors in 2019, 2020, where everybody was buying from everybody. And in a lot of cases, if you just had a good product, it wasn't very hard to reach your quota. All of a sudden, it's a different industry. It's an entire different industry. Now, I joined the workforce in 2006. I didn't really understand what was going on in 2008. Like, I can't say I'm one of the veterans that have experienced that or the dot-com era, but a lot of the frontline managers right now, they joined, you know, 2015, 2016, right? That they did this individual contributor for a few years and then got promoted. They have never experienced that. And it was easy to sell back in 2020. Now it's much
Jason
harder.
Jason Lemkin for SaaStr has a great set of expressions there, and like 2024, it's gotten hard. Um, but well, great. Well, Roy, this has been awesome. Just as we wrap up, I'd love to do the speed round. The speed round, as you may remember, is what's your favorite metric and why? What's your favorite book? It could be personal or business, and why? And then who's the influencer that you're following, either LinkedIn or through email, someone that you find that's actually writing cool, interesting new stuff, not just part of the echo chamber. So, favorite metric. What's your favorite metric?
NDR.
Okay. And for people who don't know, NDR is net dollar retention. Why is that your favorite metric?
Because I think that's indicates the health of the company. So how basically that's the renewal rate. How much of your customers continue with you, and that's the greatest indicator of, yeah, you're delivering impact to your customers. They want more of that. You're doing something right, and I think that's the best indication of a healthy company offering.
Got it. So beyond what we were talking about early on, which is gross retention, which is just can you keep the current cohort of customers at their spend level, NDR being they're buying more from you, either more
Yeah,
seats, more modules, or you've penetrated the organization by going across division. You've
that's right.
demonstrated value and they want more. Okay.
Yeah.
What's your favorite book?
It's not a business one. I don't know if
That's
it's
fine. We've talked about fantasy, science fiction, horror on this
ca-
podcast. What's your favorite book?
yeah, my favorite book is Cash 22.
Cash oh, Catch 22. Oh,
Yeah.
brilliant. There you go, a little throwback to,
Yeah.
Catch 22. Why is that your favorite book? It's a interesting call.
Anti-war
Ah, there you go.
book,
Yeah.
right? Very a lot of sarcasm there. I think I read it like 5, 10 different times. I don't know. Like
Have you really? Oh gosh, yeah, no, I do think it's a sophisticated read. You have to be able to your point, understand the multiple levels of it and how it plays out, and it's a really compelling. Great recommendation. Okay. Influencer, person that you're reading or listening to on podcasts or reading their emails that you think is really thought provocative.
yeah, yeah. Probably you've heard that a lot, but Scott Galloway, Professor G.
Oh yeah,
Um,
awesome.
I just love
He
it. Even
yeah,
him and Kara Swisher,
yeah.
my go-to podcast. I listen to every podcast. I just love that. I think he's very thought-provoking.
Oh,
I love his view and how he analyzes different things, and I think he's fantastic.
wicked smart, irreverent, funny. Huge ego, but at the same time, self-effacing.
Exactly.
He's got a for people that are listening. This may come out after. He's got a conference coming on around AI. I think it's this week or next, and I'm really excited because I think he asks really good questions. It's not just the same that everyone else is. Well, Roy, this has been great. Thank you very much for your time. Really appreciate your insights.
Yeah. Thank you for having me.
And just as we wrap up, if people wanted to find out more, is LinkedIn the best way to reach you, or what? Would how would
Yeah.
you
Yeah.
prefer?
Yeah. LinkedIn is the best way. Yeah.
I
And
think
when
that's
you
how
go
we
down
got
more
connected.
the website of the company, if you want to go to directly to the website.
Yeah, and that's Winning by Design, and it's an awesome website. Awesome website. It's an awesome company, awesome approach. We are, as I mentioned, customers. It took me a long time to get over the investment, but I will tell you, I just went through my QBRs with my AEs, and they all said it has been a worthwhile investment. But to make it pay off, to your point, it has to be inculcated into the process and technology. We've adopted the SPICE framework in our Gong. We're monitoring calls, using it, and so it has to be an entire behavior change and commitment to doing things differently for it to work.
Exactly. Yeah. We haven't found the magic potion on coming into a company and after 3 to 6 months changing everything and doubling the revenue. It takes time. It takes changing people's behavior, cultures, processes. It takes time.
Yeah, and to your broader point, the final comment is, and the people who do this and survive it as sales managers will be great sales leaders in the years to come.
That's right. Yeah.
Awesome. Well, thank you, Rowie. Have a great day.